Trade tensions continue to weigh on the markets. Stock indices around the world continue to struggle as President Trump ramped up his tariff plans this week. But worries are increasing that his policies are starting to hurt the US economy. Well, Paul Flood is head of mixed asset investments at Newton Investment Management. Paul, what have you made of the US's plans this week on tariffs? Are we getting in a situation where we could be heading for a full-scale global trade war?
Well, I think there is a bit of a risk of that. I mean, it's pretty clear from the Trump administration that they want to rewire the global economy. Globalization has really pushed a lot of the middle class or lower end jobs across to China. And whilst globalization was great for productivity and led to a big deflationary force that benefited much of the West, we have seen China upskill, and that has led to a lot of the lower end jobs in the United States going away. And that's a bit of a risk, and the Trump administration is very clear they want to fix that. And so whilst a lot of the discussion was around whether tariffs were more of a negotiation tactic, I think as the months have passed, it's become very clear that this is much more about getting manufacturing and jobs back to the United States. And Europe, Canada, Mexico have to wake up to this, and certainly we're seeing this is a more aggressive stance. The Biden administration tries to use the carrot with the Inflation Reduction Act, the CHIPS Act, and the Trump administration wants to move this faster, and they don't want to have to pay for it, and so they're using a bit more of a stick with the tariffs, and they're trying to ensure that it doesn't lead to more inflation. They're trying to get the car manufacturers to make sure that it doesn't come through in prices, and of course that will lead to a hit to corporate profitability. On top of that, clearly it's having an impact on consumer sentiment as people see the headlines every day, not just on the tariffs, but also the DOGE and the job cuts. That is leading to a bit of a hit to consumer sentiment in the United States.
You talk there about consumer sentiment, and actually, the figures are pretty worrying. I mean, consumer confidence is at a almost 4-year low. Is the US economy hurting already from these plans?
Well, I think certainly in some pockets we are seeing that start to come through. And we've seen a GDP nowcast earlier in the year that really started off the concerns in the equity markets. And if you break that down, clearly exports and imports were a big part of that. That may well be temporary as manufacturers and retailers brought forward some of their purchases to try and avoid the impact of the tariffs, and so that may well unwind. But as you point out, it's the consumer side of that that is perhaps more worrying. And again, that might just be temporary as people push back on some of their purchases, particularly large purchases. But there's also contradictory data coming through from some of the banks and the credit cards, where it's true that some of the bigger purchases aren't going through, and we've seen that with some of the home builders in their recent results. Whilst footfall is still high, it is the transactions that are not taking place that is certainly a little bit more worrying. But when we look at the credit card and the banking data, there is some hope that perhaps consumers are just shifting their spending patterns into other areas.
Now, earlier you talked about the fact that the US's trading partners had to wake up. So what exactly should they do, especially here in Europe?
Well, I think they have to take the US much more seriously at face value. We've seen the US through some of the leaks and comments that have been made by the Trump administration that they're fed up for paying for global security, and other people need to step up. Alongside that, the US allies are a little bit more concerned that perhaps the US is a less reliable ally, and so they need to pick up on their defence spending, but also on their industrial grid infrastructure. And so that should lead to better opportunities in Europe versus the US. The US represents about 4% of the global population, about 25% of global GDP, yet it's 65% of the equity market. And so perhaps we'll see a little bit of a rebalance away from that.
And that was Paul Flood at Newton Investment Management. And don't forget, you can watch more videos on Reuters.com.